Good morning. Welcome to Market Insights from Southwest Investments. I'm your host, Rick Zeke, and joining me this morning is Bart Shanna. Bart, good morning to you.
Good morning.
You know, it's February already in 2020, and I've had numerous client meetings, and it seems like the same thing over and over. People want to know. We had a fantastic year last year in the market in general, and many portfolios performed very well, but they have concerns over what's going to happen this year.
Mm-hmm.
And
which is not unlike any other year, by the way.
Well, exactly. But it just kind of comes down to they had great years, and so they're kind of expecting. Okay, can we continue to expect this sort of thing going forward? And in the fourth quarter, we had a little bit of hesitation from some companies on their earnings. There was a little bit of a scare on some companies, and retail has just been tough for the past few years. But then we had Apple come in with record earnings
in this year,
in the first quarter of 2020.
Uh-huh.
But then Amazon just last week, they had an expectation of $4.11 for their earnings per share, and they knocked it out of the park with 6.47. So that is a huge amount for them to come up with on their latest quarter, and that really sent the markets up. What do you feel like that's going to do for us? Is that kind of project what the future is going to be like for this year?
Well, clearly that revises the fourth quarter estimates.
Yeah.
But what it does is, it kind of validates a little bit the consolidated consensus of earnings estimates for 2020 are expected to be around 10%. According to Bloomberg, that's where the analysts are pegging it at between 9.9 and 10% earnings growth for 2020, which is terrific, especially after following last year.
Mm-hmm. Mm-hmm.
But then the next question is, well, what does that mean for the stock market?
That's right, because earnings is important, but in the end, our portfolios and things like that, what does that mean for the market in general?
Correct. And so what we see is the stock market is currently trading at 19.6 times trailing 12 earnings. And as we look at upcoming estimate for next year, the market is currently sitting at about a 17.8 times. Okay, so what does that mean? What do those numbers mean? Well, the best way to put it in context is Peter Lynch, the former manager of one of the most successful mutual fund countries in the history of the U.S., the Fidelity Magellan Fund, came up with the rule of 20. And in this case, the rule of 20 was you take the number 20, subtract inflation, which was about 2%, and that would imply the market is fair valued at 18 times earnings.
Okay, 18 times, and so that's a just really simple calculation.
Simple calculation, rule of thumb. But if forward PE is 17.8 times, that would imply that at current levels, with earnings coming in at 10% increase, we are currently fairly priced.
Okay.
Now, if earnings get better than that, or if we have any PE multiple expansion, the market will drive higher.
Yeah, and one of the things that I'd like to point out is I picked two very big companies, two big tech companies, and the scare also is, are we going to have another tech bubble and things like that? But everything that I've read is that they don't have high expectations for tech companies as well, and so this tech bubble that happened 2000,
right?
Their earnings are matching what their PE ratio.
Yeah, that is the big difference. Is this time we actually have the earnings to support it.
Exactly. Well, thank you, Bart, for that insight on that. I appreciate that. And thank you for joining us. Make sure you come back next week, and we'll have some great insights for you. See you next time.